Hello traders, Jeff with OptionBoxer.com. Wanted to make another video today. I guess I've kind of got caught up, just trading myself, and I've kind of operated under the assumption that most traders are where I am, and I think maybe I've mistakenly done that. So what I'd like to do is I'd like to make a couple of videos here, and if I can get it into one video, I will. But likely it'll need to be a few different videos, kind of have a playlist for new options traders that are looking to trade options but don't really know where to start. So I have the information kind of all laid out here on my website. If you go to optionboxer.com, and you can see here how it's spelled, and I have it all laid out here. But some people, if you're like me, some people want to see a video versus read it on a website, and maybe it offers a little bit of I guess confidence in the material when you have someone actually telling you, and someone that's actually a trader just like yourself, or like you're aspiring to be. So so if you click here, click on fundamental course, you can click that, or you can click you can click fundamental course and then click start here. And you can see I go through, and I'm not going to read this word for word other than to just highlight a couple of things. So basically I'm just telling you what options trading is. I'm highlighting right here the Chicago Board Options Exchange is a great resource for new options traders or for veteran options traders. It's just got a lot of information that could be very beneficial. So you definitely want to check that out. This right here is just basically telling you that you understand the disclaimer, and that disclaimer is nothing more than this. So I'll take this opportunity to plug it in. Options trading products, services, and or information, including this video, are for educational and informational purposes only. Basically, you are on your own. So if you make money, it's yours. If you lose money, that's yours too. And so make sure you do your own research prior to placing any trades. Options trading can be risky. Trading of any kind can be risky, so make sure you understand the risks prior to doing so. You should also take a look at the standardization and risk characteristics of options, and that can be you can look on Google to find that. So let's see if I can spell it correctly. Risks of, I'm sorry, I said it incorrectly, but characteristics and risks of standardized options, and you can see it's at the Options Clearing Corporation. You can click there and you can go through and find it. There it is, a download that you can read. You can see it's quite lengthy and fairly boring, but that's something that you should understand. At least, well, you understand it as good as you need to prior to placing any trades. All right, so moving right along. So once you get through kind of reading this, if you wanted to read it, you can click next, and we kind of continue on the fundamental course. Starting here, the two most important rules of trading options. These are the two most important rules, and really the first one is the most important, and the second one is if you want to trade options for any length of time, you need to understand rule number two. So rule number one is options expire. They all expire no matter how long out they go, and we'll look at all this as we go through this series of videos. I'll try to keep each video around 10 minutes, and then start a new video from there. So options expire, and you want to make sure you're protecting your capital. So don't be afraid. Basically what that means is don't be afraid to take a small loss before it becomes a big loss. And then there's some common myths that go along with trading options. I won't go through them all. Options are too risky and should be avoided. Well, that is true, but it really depends on the trader or the investor, how they use them. Whether that is true or not. So options are inherently risky because they're leveraged products, which means percentage wise, you can take a trade with one contract in an option, with one option contract, let's say a call option for example, and instead of buying stock XYZ for $100 a share, you can buy one call option which gives you the right to control 100 shares for $2 or $200 in premium. And of course the 100 shares of stock would cost you what did I say, 100 times 100, so 10,000, I guess, if my math is correct. I believe it is. And so anyhow, you can see for a lot less capital you can control the same amount, and then percentage wise you're going to see a higher return if stock XYZ actually improves and it moves higher in price. There's some other myths here, and you can feel free to look at those on your own time, but let's move along. So terminology, this is kind of important. So we're going to go through each of these, and this will probably wrap up this first video. So what is an options contract? Well, an options contract is a legally binding agreement between two parties. One party agrees to buy and the other agrees to sell, or vice versa. If you're the seller, then somebody's got to buy it, and if you're the buyer, somebody's got to sell it. There are two types of option contracts, calls and puts. And again, we'll get into all of this and how it looks throughout the series of videos. What does being long an option mean? Well, being long an option means you are the buyer. It means you paid for it. You paid money to get it, or otherwise known as a debit. The alternative to that is a credit. And so what does it mean to be short an option? Well, being short an option means you're the seller. You accepted payment for it. Basically, if you're long and you bought it, your risk is limited to whatever you paid for it. If you are short the option and you received credit for it, well, your limit could be infinite, but I'll show you in this series of videos how you can set it up to know what your maximum loss would be at entry. So what is a debit? A debit is money you've paid as the buyer of an option contract. A credit is money you've received. So when you sell something short, you will receive a credit, whether that be $10 or whether that be $10,000. If you're short at some point, you'll have an obligation, and we'll get to that next. You'll have an obligation to do something, and unless it expires worthless, in which case you'll be allowed to keep the credit with no additional obligation. All right, with those items decided, I think going forward, so what is a bid and what is an ask? Well, I think the easiest way to show you that would be to show you an actual options chain. So let's go to the trade tab. These are some orders I was looking at, so we'll delete that. And let's just look here at October 18th of 2019. And that's kind of, you'll see right there, this is September the 30th of 2019. And then if you minimize that, you can see all the different expiration months, with the longest one listed being December 17th of 2021. So you can see they go out quite a ways, but they do have an expiration stamp, and that expiration is in 870 days. So just be aware of that when you're trading options. But we'll look here again at the October 18th of 2019 expiration month, and you can see there's both a bid price and an ask price. And commonly what traders look at is to see how far apart these two numbers are to know if it's a liquid market. Well, you can see it's 10 cents wide right here, but the market is currently closed. But you can see, but typically on the SPY ETF, it's a very liquid underlying, and liquidity basically means how many traders are in the game. You don't want to buy something and not have a liquid option. For instance, if you bought this down here, you can see there's no premium, so nobody would buy it, but you can see there's also no open interest and no volume. You can't see the full word there, but open interest and then volume. You want both open interest, which is high here on this at the money contract of 10,745, and then you had a little bit of volume today, a little light compared to what I'm used to, but I bet it's a lot heavier up here near the money, and you can see it is 4,615. You can see the spread's a little bit tighter, but again, these spreads are usually 1 penny wide, and basically the way the spread works is if you're going to buy it, you're going to pay 188. If you're going to sell it, if you're going to buy it long, you'd pay 188. If you're going to sell it short, you would receive 183. So we'll look more at that as we go, but that's basically the bid and the ask spread. And I already talked about that, the price difference between the bid price and the ask price. The strike price, the striking price or the strike price is the agreed upon price by both parties at which they will buy or sell shares of stock on or before expiration. So this gets a little more, and I'm running out of time on this video, so this might be the last point I'd like to make, and then I'll end this particular segment. So the strike price are these prices you see listed here down the middle. This is the put side, which also has a bid and an ask, and this is the call side, which has the bid and the ask. And so basically, let's say hypothetically I wanted to buy this $297.50 strike price call. I'm going to pay $1.88. So I won't get into too much detail yet, but other than to say, this contract, if I buy long the call option, it gives me the right to buy shares at this price. So if I have the right to buy shares at $297.50, that at any time throughout the next 2 days, now that's, I'm looking at the near term expiration there. So let's go back to my October 18 of 2019. And so if I bought the 298 call long, I have the right to buy shares for $298, but look, I'm paying $745 because you have to multiply this by 100, because every one call option contract gives you the right to control 100 shares. So I would pay $745 for the right to buy shares at at 298. So if the market went up to 350 and I have the right to buy shares at 298, well, you can see I have the right to buy shares at way under what the current market price is, so I could buy them and then turn around and sell them for a profit. And that's kind of what options allow you to do. They allow you to look at something and say, okay, well, I think in the future this may be worth this, or it may not be worth this, which is why you would want to sell short. But regardless, for just the sake of this one particular strike price discussion, just know that it gives you the right to buy shares at this strike price 298. It also could mean if I bought this one down here for 303, it would give me the right to buy shares at 303 or whatever call option or put option. It works the same way for puts. So if I bought the 285 put option, well, now I have the right to sell shares. So it's a little different. You have the right to buy shares if you buy a call option, but you have the right to sell shares. So let's say you had 100 shares and you bought this put option and price went down to 200. Well, now you have the right to sell your shares for $285, but we'll get more into that next. So in the next video, we'll go ahead and start looking at expiration dates, in the money, out of the money, and we'll continue our discussion here. Thank you for watching.